Good afternoon. Welcome to the TheoTrade afternoon video. I'm Blake Young, and today is October 16th, 2025, and we're going to talk about the idea of technology putting in a top and fading the AI frenzy using financial ratios today. So we're going to talk details about some potential setups that I'm seeing in stocks that don't have the financials to survive a storm. So on this XLK chart, and we could use XLK, XLC, NASDAQ, we could use any number of things here, but I want to focus on technology today. And to me, this is shown that we put in a top by the fact that we sold off, we recovered halfway, and all we're doing is rejecting that halfway over and over again. We've gapped up, closed down, gap up, closed down. Those are indications of what we call an exhaustion gap, and it's struggling here. So what I want to do is say, okay, if this is a top, and we are finding the extreme edge of the technology sector or communication sectors, what stocks financially will struggle? Now, one of the incomes, or one of the financial ratios I love to look at, in addition to quick ratio and current ratio and free cash flow, is fixed coverage charge ratio. So I've got this fixed coverage charge ratio, and it's year over year percent annual, and we're simply saying show us it's below zero. Now, to give you the quick numbers, this is in the newsletter that I'm sending out today as well, but the ratio is EBIT plus fixed coverage charge divided by fixed coverage charge and interest. Now, you don't need to know any of that. If you're not a financial analyst, if you're not an accountant, don't worry about it. But the idea here is that what we're saying is based off their earnings before interest and tax, add that to the fixed coverage charge, that's leases and monthly expenses and debt coverage and interest payment, and divide it by the same. If it's below zero, if it's a negative number, then that fixed coverage charge is going to show you these companies that are going to struggle. So when we're looking at that as a number and as a ratio, we want to look at it as current and make sure that we are at a level below zero. And we're going to sort it and look at these that are negative. Negative, 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 negative. That means their earnings compared to their fixed coverage charge is dramatically skewed against them. The costs that they know they have, their leases and their rent and their debt, they know what those charges are. This is not adding any additional charges, any unforeseen, any variable expenses. These are the fixed expenses they know that they have, and it's the same every single year. This means they do not have enough money to cover any of that. Now you'll see we have Snowflake, Cloudflare, Unity Software, CrowdStrike, Intel, Datadog. And I ran these numbers, and we also pulled up in the communication, TTWO, Roku, and Net. So we're going to look at those stocks as potential opportunities. And what we want to do is say, if they are struggling financially, ratio-wise, then can I time a chart to get into a short trade that could turn into a very long-term downtrend? Or can I just get paid for my willingness to not buy this? Let's start out with the ones that I talked about in the newsletter, and that's going to be Roku. And as you can see, Roku has created a widening pattern, cleared out all the traders. This is lower highs, lower lows, and we're in a downtrend. I think Roku could easily go down to 80, if not lower. I think you could get a 15 to 20% drop in Roku. But if I look at Roku a little closer and look at the implied volatility as a percentile versus the year, I'm going to scroll down. You'll see 56 percentile. Anything above 35 I'm interested in selling. Certainly above 50 I'm interested in selling. And we're going to stack these, and you're going to see how well they price out. Now, if I'm going to sell what I think is not going to happen, and that means move higher to the previous highs, I will sell 3 to 4 weeks worth of time. I will sell an out-of-the-money call spread, and I will collect as much premium as I can. And I generally like to sell premiums below 42 delta, somewhere between 30 and 40, but 42 is kind of the edge. So if I sold the 42 and bought the next strike out, this will give us a spread. And right now, this was not the case earlier. We had this at about a 35-40 cent spread, but the spreads got really wide here going into the end of the day. You can see that we got really wide. 40 cents here and $1.30. The 102 is $1.30, so that one's not going to work for us in that scenario. Earlier, these are all priced out really well, but we have excess volatility going into this close. And so what we're trying to do is get paid at least 33 cents for a significant edge in our favor. But look at this. The spreads are so crazy. We just went $1.30 wide on a $1 wide difference in the vertical. This is rough. So these were set up really nice for an opportunity to take the trade, but now they've unwound that. Let me go through these others really quickly, and we'll just see if they're even pricing now. Nope. Net has a $1.50 apart. So I'm going to tell you we need to watch for these tomorrow. And what we're going to do is we're going to look for selling deltas of 42 or lower and buying the next strike out and making sure that we're getting paid 30 to 33 cents per dollar wide, because that's a dramatic edge in those trades. Generally, we only need 25 cents, and these were pricing extremely well on the setup. But now the spreads have gotten so wide that they're bigger than the distance between strikes. And so $1, $1.20, if we were to do these trades, we'll still structure this one. Let's go ahead and do the 225, 230 just so we can see. And we'll do this on TTWO. These change dramatically. So I don't know if we're going to get 195, but if we can get $1.85 on $5 wide spread, that's that 30-cent return or better. And this is a statistical edge in our favor. So I'd sell the 225 by the 230, and we're going to get paid $1.95. We'll say $1.80 on a $5 wide spread. If I get paid $1.80 on a $5 wide spread, then what's the return on risk? Well, the return on risk is going to be, we're getting a $1.85 payment versus a $3.15 max loss. That means we have to be right 62% of the time. Well, we're selling the 42, so that's going to tell us we're going to be right 58% of the time, 100%. But we're buying the strike out to protect it. That means we're going to be right 63. So there's a tiny bit of an edge for the payment we're getting here in net. But let me show you TTWO. So TTWO, this is Take Two Interactive. If you scroll down the bottom, this is the highest implied volatility, and it's at 80%. When I was running the numbers earlier, this is at 75. So we're increasing our implied volatility. We're seeing bigger swings, and again, we're getting about a dollar wide spread between the bid and the ask. This is very dramatic swing in this last hour of trading. So we are getting some selling, some higher volatility. It would be better to wait in the morning, but let's go ahead and run the numbers anyway. 39, we'd sell this one. We'd buy this one. Now you won't see this until later tonight, so this was perfect. You'll be able to do this and run the numbers in the morning. This is $1.50, so it's right on the edge if we can get the $1.50 or higher of getting 30 cents per dollar wide spread on TTWO. But we're selling a delta of 39 and buying a 34, so we have a 66% probability of not losing the entire max loss here. It sets up for a high reward in this high volatility time, and simply saying, I don't think we're going to go back to those highs on stocks that do not have the financial backing. And I do like this setup. This is a monkey bar breakout. We should go back to 245 on TTWO, and we're just simply saying, don't go through the highs again. That's it. We have plenty of room, and we just need to have it not go through the high. Now, what I did not cover in the report that is going out is Crowd. I like Crowd set up here. It did trade through this 3-week low, but it didn't close down through this low. That gap is going to come into play. I think we're going to 446 and then probably down to 410. If we can go to 410, we're talking a 20% drop in CrowdStrike. And looking at the options on CrowdStrike, if you scroll down here to the bottom, you can see we have an implied volatility of 23%. This one's not expensive. This would be a directional play. You could buy a put rather than sell the stock short, but you still have that choice if you want to sell the stock short because it's easy to borrow. But you can play the leverage a little bit better and reduce your risk because you're buying a put and not investing $478 per share. So if we're going to short here, we could do the same thing with the put. I like to buy deltas of 70, and I like to get paid at least that extrinsic value, in this case 9940. So I'd buy the delta of 70. I would sell at least that 995, and I'd go up here and sell the 440. So that would be, it's actually gone up again. So we're going to get paid, we're paying 1050, but we're going to go 440. And this turns it into a theta positive trade. It costs $41 or $4,100, but the spread, assuming we do go down to that next target, is going to be worth $80 here. So it's almost a 1-to-1, but it's a positive time decay, and it doesn't have to go down to make money, but if it does go down, it has a potential of becoming worth an $8,000 trade. Now, Crowd is a little more expensive than the others. So let's look at one more. And this one is Unity Software. This one to me looks like it's already started its downtrend. We reversed here, we broke support here, we broke the next support, and we're creating lower highs, lower lows, lower highs, lower lows. And this breakout should be able to get down to 32.50. It's an inexpensive stock. I do think you're going to go for the gap, which is 29, and even then that's a 10% drop. So let's look at the options, or our choices and the options here. One, it's easy to borrow, so you could certainly just short United Software. You could go down and look at the options, say, are you inexpensive or expensive? They're expensive, and so therefore we can just sell the call verticals for 3 weeks and collect the premium. Now, if we sell that delta near 42, we're going to do the 38. I'm going to buy at least $1 wide spread, or enter $1 wide spread, and this is 25 cents. So this is not as high of a return as I normally would like. I like 30 cents for these high leveraged ones, or the high implied volatility, but it still would meet my conditions at 25 cents. I do think our numbers are being messed with because all the spreads got wider in this last few minutes after we saw the market try to sell off to the lows right before the close. So check all these again tomorrow. There's a lot of stocks that are worth looking at. Datadog as well. There's a number of stocks that do not have the ability to meet their fixed coverage charge in their current earnings. Datadog has a 54% implied volatility. You could be a seller here or sell the stock. If you look at Datadog on the charts, it's a similar setup to TTWO. It looks like a breakdown. It looks like a monkey bar. If you're getting back through this previous high, I expect it to come back down and find 135. There's about a 15% drop in there. Or sell the call vertical with a delta near 42 and look to get that 30 cents per dollar wide. This needs to regulate and get back to a tighter spread, so check this one in the morning as well. All these are pricing really well, but the spreads got super wide in the volatility in the last few minutes. So don't chase it. Relax, wait until the morning, set up the trades, make sure you're getting paid 30 cents per dollar wide spread on any of these to sell the call verticals. And we're looking to fade the stocks that do not have the financial ratios to pay for their fixed coverage charge in the technology sector. This is what I think are going to give you the real advantage. And so join me again tomorrow. We'll take a look and see if these numbers are playing out. Have a fantastic night, and we'll talk in the morning.